Options on Dividend Stocks by www.options-trading-education.com. In options trading, one seeks profits from changes in the price of the underlying stock and therefore the value of the options contract. Stock investors hold on to dividend stocks because of the quarterly income that dividend stocks provide. How does it work to trade options on dividend stocks? The Options Guide explains the effect of dividends on option pricing. Cash dividends issued by stocks have big impact on their option prices. This is because the underlying stock price is expected to drop by the dividend amount on the ex-dividend date. Meanwhile, options are valued taking into account the projected dividends receivable in the coming weeks and months up to the option expiration date. Consequently, options of high cash dividend stocks have lower premium calls and higher premium puts. Options are usually priced with the assumption that they are only exercised on expiration date. Since whoever owns the stock as of the ex-dividend date receives the cash dividend, sellers of call options on dividend-paying stocks are assumed to receive the dividends, and hence the call options can get discounted by as much as the dividend amount. Put options gets more expensive due to the fact that stock prices always drop by the dividend amount after ex-dividend date. Aside from the short-term effect of dividends on the premium, trading options on dividend stocks is the same as for non-dividend stocks. Traders seek to anticipate price movement and trade accordingly. Do dividends add extra value to stocks? Solid companies that have been paying dividends for decades often trade at a premium to similar companies that do not pay dividends. This is partly because of the perception of strength and value that an unbroken string of dividend payments for decades gives a stock. However, that extra value is factored into the stock price by the market and does require an extra calculation like the dividend does. To the extent that investors might be expecting a company to increase its dividend payments, this will factor into the option price. Multiple option strategies and dividend stocks. An old but still useful options trading strategy is the long straddle. Options traders often use this approach in volatile markets. A long straddle is buying both a call and a put on the same stock with the same expiration date. In a long straddle option strategy, the worst a trader can do is lose the cost of the premiums paid for the call and the put if the stock does not change price. However, this options trading strategy has potentially unlimited potential if the stock price changes significantly. When trading long straddle options on dividend stocks, the call option may be discounted by as much as the expected dividend payment, and the put option may be increased by the same amount. Hopefully, this will result in the same total premium payment. If you execute before the ex-dividend date. In trading options on dividend stocks, if you execute the contract before the ex-dividend date, you will be the one getting the dividend in the case of a call and losing the dividend in the case of a put, which is one calculation to factor in when trading options on dividend stocks. For more insights and useful information about trading options, visit www.options-trading-education.com.